Hey traders, welcome to Charts and Coffee. Cracking out broke out the Kraken mug today. Welcome everybody, happy Monday. So Friday saw the Kraken released. We saw the sell-off into what was a very strange week because of, there being really only two real full trading sessions. Wednesday was kind of funny because it's going right into Thanksgiving. Thursday was a half session. So just a strange series of trading days. But Friday definitely saw the market start to discount just this brand new narrative in terms of variant. We know that the types of reactions we would have seen in any of the previous discounting of the uncertainty around the variant sees crude oil heading lower, Dow heading lower, S&P, but tech remaining quite persistent. Online retailers able to stay pretty resilient. And so it was just that playbook all over again. Now, a lot of traders asked, would I be interested in buying into that sell-off? And the only reason we wanted to take a pause was, first of all, we're going into a weekend where we don't know the narrative. Does it accelerate? Does it worsen? I mean, do we just see the volume turned up on it? And the other reason, far easier to measure than the subjectivity of perception, is we exceeded the daily price movement range. We exceeded that historically normal amount of price where once we start to move past it, probabilities and predictability, which are kind of the same thing, right, in terms of the way we view whether or not our trades are more likely to work than not, started to, that starts to unravel a bit. Not that the market's incapable of a balance. In fact, most of what we talked about on Friday was, hey, get your wish list ready, get your watch list ready, get a list of those things that you want to buy ready, because the opportunities to do so in the double green corners of the market are a coming. And I'm still very much a fan of the long side of the market. As we go into December, there's sort of these three sort of stages of the year-end rally. And again, not that we know there's going to be sort of what I call an echo of Friday sell-off into Monday morning, but you never know. So let's wait for the setup, minor low, inside day. We still have plenty of the year left. We still have plenty of what I do believe is going to be the window dressing kick in. This is not the time to take a look at laggard stocks and sectors of the last month or even this last quarter, because window dressing is going to disproportionately benefit those stocks that were already strong while weakening those stocks that were already looking like nobody wanted them. So that is where we are as we roll into December. Let's kick off our conversation here with your questions. And Donald asks, what is the point of control? Right, volume profile, what's its significance? So point of control is pretty simple, Donald. It's the single price level that has the most volume. Now, of course, that's subject to how far back you're looking, or market memory, look back, whatever the terminology is you prefer. So looking at a certain set amount of data, what is the single price level that has the most volume? And so what's the significance? Well, what's the significance of volume? Why would we want to know there was more volume at a certain level? Because there's more commitment there. There's more attention there. That's the significance of any kind of volume analysis. All right. So I hope that helps. All right. Moving on. Michael, GLD and Oracle. Sure. So if we're looking at GLD, we're going to take a pit stop at GC. I don't feel that we have a really clear edge in GC. And if I don't have a really clear edge in gold futures, I'm not going to have necessarily a clear edge in GLD, the gold ETF. Do I want to be long? I do. I like the idea that if real yields are dropping, that there's a chance that gold moves higher. And I'm much more a fan of that narrative than I am that gold moves lower. But take the narrative out of it and just look at the structure of the market. And there's not much about the structure that, for me, yields a lot of high probability setups. Sure, we could set up a buy. Sure, we could probably argue about where to buy, where to sell. But if I am looking at a market and I could make pretty compelling arguments for both a long and both a short, depending on the levels we're going to, I probably don't have an edge there. Meaning, if I look at a chart, it should be compelling in one direction, not a good argument for both. So I am sort of stuck in the ladder where it's not that compelling, especially where it sits right now, to either direction. So I'll just pass. It can stay on the watch list, but I'm not really in a hurry on the daily time frame, anyways, to do anything with gold. Oracle. So this is where relative performance is such a key part of what I do, especially as a stock and ETF trader. So Sector Secrets is all about how do we look at the indices? How do we look at the ETF and do top-down analysis to understand why certain stocks are moving the way they are? And it's not that top-down is better than bottom-up. I'm not in any interest in, I don't want to belittle someone else's approach. It's just not my approach. So I look at top-down because the way in which ETFs have become very, very influential over the stocks that are weighted within them is something that is really undeniable. So why not use that to our advantage? All right, what does this have to do with Oracle? Well, we know that Oracle is weighted within certain indices and ETFs, and it's not really a leader. It's not really even matching up the clarity in the indices and ETFs that it's in. So it's actually a laggard, or it's not in sync with what we're seeing in terms of the broader group, right? The sector, the index that it's a part of. And I usually don't, I've had my eye on it, don't get me wrong, but I usually try not to prioritize markets that aren't in sync with the index or ETF that it's weighted within. It actually drops the predictability of what it will do next. So if a stock or an ETF, well, so let's start at the bottom. If a stock is in sync with the sector, it's a higher degree of predictability. If the stock and the sector are in sync with the index, higher degree of predictability, because it's a tide and boats conversation. I don't want my boat to have to do something where it's fighting the tide. All right, that the boat is the stock or the smaller thing, and then the tide is that larger group. It could be the sector, it could be the index. So I would probably just sort of watch for a bit and then see if it sort of starts to move with the rest of the group. As far as crude oil goes, when we sold off and hit the 200, it was so tempting to say, what the heck, let's just fade this 200. But again, it's not a matter of was there a buy. I don't want to short it. So that's an easy determination. Most of these markets, the indices, most of the sectors, not all of them, energies like crude, oil stocks, I do want to buy them. But again, for me, I've been getting a lot of questions about when we're in chop, do we want to buy into the bearish momentum? That's quote unquote a fade, right? Do I want to buy into that bearish momentum? But once that bearish momentum exceeds the price movement range of historical volatility, I'm going to have to wait. Are there times where on Friday into the close, traders might have gone ahead and faded that bearish momentum? Sure, but it's really a coin flip, and it's actually very difficult to manage risk because one, it's the weekend, and two, you're basically susceptible to whatever happens Sunday. And then Monday, and if it's a stock or ETF or option on a stock or ETF, you're then waiting for 9:30 to do anything. And by then, everybody knows whether they're on the right side of the trade or whether they're on the wrong side of the trade. So I think it's harder to control risk. Not that there's not an opportunity to make money. That's not what necessarily good trading is. Good trading is there's an opportunity to make money and I can control risk. And for me, that latter just wasn't there. But was it, are we gearing up for a buy? Oh gosh, yes. Again, there was no utterance of shorting that for me. And frankly, there weren't really a lot of setups as far as I was concerned in front of that sell-off. That was a sell-off that was really triggered by news. I think a lot of traders wanted to see the market pull back, so they didn't need much of a nudge. And then that variant was all the reason, really, that a lot of traders who just had a very itchy, they had a scratch to itch, as they say, and it was, hey, we want to see this market head lower. They got a reason, and you saw what happened Friday. Natty gas. So natty gas shot up, and I've been talking about the fact that when you have a market in chop, and that's always our first job as traders, are we dealing with a chop or are we dealing with a trend? This is chop. And I've been telling everyone here, and if you missed it before, anyone out there, if you missed it before, listen to me now, believe me later, this works really well. And natty gas is making me look probably a whole lot smarter than I really am. Okay. You got a choppy market. Find the recent swing high, find the recent swing low. I went to this Darvis and I went down to that low. You could have gone to the Darvis as well, but that high, that low. If you wanted to go to that high to that low, it was even easier, but that's what I was looking for, right? So take that recent range, cut it in half. And for whatever reason, again, you look at charts long enough, you stare at these things, you study them, you put on enough trades, and you start to see certain patterns emerge. And they're not patterns that are tricky or even indicator based. They're just tendencies. And there is a tendency in chop for the market to go about halfway through the range and typically exhaust, not reverse from that middle as it's doing here, but that's the target. That's what happened. Natty gas shot up, hit that halfway range on the button, little bit of a wick above. I mean, barely. That's it. So natty gas now, this is you reset the trade, you look for the oversold zone. I don't know that I want to keep fading natty gas. I mean, we had a fade that we had put on as sort of the last dance long with natty. But what's going to be very tricky for a lot of traders is they're expecting it to go back up here or maybe back up here. And what I'm trying to tell you is that's eventually it could be something that natty does. But initially you get to that halfway mark, you go ahead and scale out, move the stop to break even. You pay yourself at that level. All right, next up is JR asks, I have a very small account and I'm trying to grow it. I can't afford the paid service, so I'm thankful for these free videos. Oh, yeah, JR, look, Simpler has been putting out free content for a really long time. I've been working with Simpler since 2013. Back then, it was a site called Trade Forex Futures. We don't even have that site anymore. That turned into Simpler Forex, and then we went ahead and revitalized Simpler Futures. So it's been a minute. Now, the reason I bring all that up, the reason we're going back down memory lane there is one of the things we did every night, sent out a free email. It wasn't very pretty back then. We sent out a free email and talked about what we're seeing in the markets. And that's, we put out a lot of free content, not only charts and coffee, but we have a free video from the option side every evening, from the future side every evening. There are different individual shows like charts and coffee that are scheduled throughout the week. So definitely check out the Simpler Trading YouTube site, YouTube channel. And then when you're ready, when you've grown your account and you've learned a lot, yeah, definitely come join us. We have a foundations training room. We have learning centers in the masteries as well as the main room. So for sure, and congrats for being prudent and taking your time to build your account and educate yourself in the meanwhile. I mean, that's I think what we all did once upon a time. So looking forward to seeing you on the inside at some point. All right, so UNG, same breakdown as natty gas. So if I talk about NG, we're talking about UNG. If we talk about GC, GLD, so same idea there. Hit that midway point on Friday. What is my take on XLRE or BAT? Two very different two very different markets, but yeah, let's take a look. So XLRE, I've been looking at XLRE, VNQ, ITB, XHB for quite a few weeks now, and I see a pullback like this and a double green. That's a buy. Now, do I want to buy XLRE broadly? Is are the options liquid for this particular ETF? Or do I want to go with an individual boat? I mean, that's all the process that comes after. That's the watch list building and the discerning part of being a trader, right? I can make suggestions. Y'all are the ones that make a decision, right? And that's the tricky part of trading. Do we want to get long here? I don't have a problem with that at all. No, we're in the wave. We've tested the middle line of the wave before. It's a viable market. The only thing that I would say, what I would suggest, is look to see if you have maybe a relative outperformer inside that group called XLRE. Remember, indices, ETFs, they're usually a collection of stocks. Sometimes there's a cash component, sometimes there's some sort of bond component, but for the most part, they're a collection of stocks. So we can look at that collection of stocks, understand the weighting, and decide if there is a relative outperformer within that group that looks better. Sometimes the boats can look better than the tide. So that's just part of the process. We want to make sure becomes a really good habit. Do our homework, right? BAT, same thing, although BAT's going to open outside of the wave, but that was a similar thing, a gap down into the wave, double green. Kind of tricky because I don't know that I want to take a shot at getting stuck in another gap. But BAT looked good on Friday. It's outside the wave today, so there's no opportunity for BAT for me. Although BAT is a really good reminder that there's two ways to look at a trend, and not one is right and one is wrong. It's which do you like? There's peanut butter and jelly. I happen to love peanut butter and marmalade. I don't know what that is. Peanut butter and orange marmalade is fantastic to me. All right, so back to the weird sandwich narrative. There is buy the dip and there is buy the bounce. So again, doesn't matter. If you like the dip, that was Friday. If you like the bounce, you're getting that today. Either way, it's a buy, right? We talk about being very clear about direction. It's definitely a buy. PayPal and V. Well, PayPal is easy. It's a short the rip. It's just that simple. It's a short the rip. And then Visa, very simple. So interesting, Jose, two double red downtrends. And for those of you, and look, I'm not saying it's right or wrong. I'm just not playing the short side of the market when I've got so many of the broader sectors and I've got the three main indices. Look, Russell, no offense to Russell traders, that's not a main index to me. Is it a tradable index? Of course, but we measure what's going on with the economy in a broad way, in the most mainstream way. It's not the stocks in the Russell. And of course, the Russell is so different than the other three because it's not a high concentration weighted sector. So why do I bring up the Russell here? It's not doing things like the others. Same thing with PayPal, same thing with Visa. It's not doing things like the others. However, if you are looking to add symbols to your watch list and to your book of trades that are short, so you're not just long, which frankly I am right now for the most part. But if you're looking to add some shorts to your book, then double reds are the place to go. So really great, two great symbols about potential shorts. Yeah, for sure. All right. AT&T, sure. All right. Same thing. And air conditioned gypsy. And this goes back to IYZ. This goes back to XLC. This goes back to those telecommunication stocks, really just dragging this XLC lower. XLC is having to fight this. Let's zoom in a bit. And a lot of the stocks within the IYZ are just double red downtrends. And that's what's to a large degree pulling on XLC as well. And T just happens to be one of those stocks. T, BZ, Comcast, there's so many of them in that IYZ ETF that are just double red, very weak. URA. I like uranium. However, Michael, we were playing uranium in the mastery, and it's been very good to us on and off throughout 2021. But most recently, we started looking at CCJ. They're not that different where uranium goes, CCJ follows. But I like the structure here. They're both very inexpensive names. Look at URA, but also I would say look at uranium as well. On average, how long am I in swing trades and sector secrets? So usually the way that the sector secrets trades are going to play out is, first of all, they're always daily time frame setups, although 2-3 days a week, we do some day trading live in the room. And then we have the daily time frame. So I do some day trading because that's part of my day. And then we'll send out the alerts for the daily setups. And so for me, based on the daily, they're usually not going to be setups that are any less than 3-4 days. And depending upon the time to expiry and the distance to the target, they could be upwards of 3 to 4 weeks. Some we have even longer, because if they just keep right on going and we have time to expiry, KRE kept going for us for a really long time. We've had situations where we just have trades that are the gift that keep on giving, and we don't have theta decay to have to contend with. So, really 3 to 4 days to 3 to 4 weeks is really, overnight for sure. Overnight for sure. Yeah, grape jelly and peanut butter. That works. That works. That does work. All right, everybody. That's it for Charts and Coffee today. Thank you as always for joining us. We have recent Charts and Coffee playbacks over in the Simple Trading YouTube channel. And as always, thank you for joining us. And I'll see you all tomorrow. Same time, same station. Be good to each other.